7 on monetary policy, and a lot of this has been covered already. So I'm going to split this into two sections. I'm going to look at the basics, which you've already looked at already, and then I'm going to have a slightly more detailed look at QE2, funding for lending scheme and forward guidance, and how those particular policies work. Right, let me start off with the main functions of the Bank of England are to create price stability, number one, and also to create financial stability within the system. So they will look at the whole of the banking sector and judge whether or not it is safe, right? So that's their two main objectives. And if the banking system starts to break down, then the Bank of England will move in and it will lend the banking system money to make sure that it keeps going. So if there's a complete run on cash within the banking system, the Bank of England will step in and provide the banking system with funds, and then that provides more confidence for the whole banking system. The next thing on there is, what is monetary policy? Well, you should know this by now, but monetary policy is three things. Number one, it's lower interest rates or higher interest rates. Number two, it's the exchange rates. And thirdly, it's also about printing money and funding for lending schemes and things like that as well. The current objectives of the Bank of England, well, these may well be changing. Traditionally, it's always been price stability. However, if we don't get any growth in the UK, we will not have stability because the national debt is going to get out of control. So therefore, because we've had low growth now for a number of years, it may be that their main objective right now is growth rather than price stability. Although ironically, even though they've tried all these various methods, low interest rates, low exchange rates and printed money, right, we now have growth, but actually during that period of time, or more recent, the last year or two, inflation's also fallen. But there'll be reasons why that has occurred. The MPC, the Monetary Policy Committee, uses interest rates to achieve stability. So if there is deflation, then they're going to lower interest rates, and if there's a negative output gap, they'll lower interest rates, and if there's a positive output gap, they will increase interest rates from there. Right, factors considered by the Bank of England when setting interest rates. Well, there are loads of different factors here. They will look at the output gap, they will look at house prices, they will look at demand in the economy, they will look at government spending, and if that's falling, then therefore they might have lower interest rates. They'll look at demand from the Eurozone, they'll look at the housing market, they'll look at exchange rates, they'll look at money supply growth. They're going to be looking at a whole host of factors to decide whether or not they should raise interest rates. And finally, hopefully, you should all know that the transmission mechanism is four main things: consumption, investment, the exchange rate will also affect the exchange rate, and of course house prices. And then that will have an effect upon the economy. Right, but even with really low interest rates right now, that hasn't necessarily created the growth that the MPC wanted. So therefore they had to move to new methods to try and stimulate growth within the economy, and that was when we had forward guidance, QE2 and the funding for lending scheme. So we're going to have a look at all of those in the second part of the monetary policy, because even if interest rates are really low, it doesn't necessarily mean that people will start spending money. If people just take their wages and put them in the bank, then there is going to be a fall in the money supply. There will also be a fall in growth. So somehow we've got to try and get some movement within the economy, and this has led to QE2, the funding for lending scheme and forward guidance, and the continuation of monetary policy. And here we're looking at three particular ways in which we can get the economy moving again, because as I said previously, even low interest rates may not mean that people will go out and borrow money. If people lack confidence, then they will continue to save money, and therefore if we all do that as a whole, that's not really doing a lot of good for the economy. So they've introduced quantitative easing, which I'm going to have a look at, and forward guidance, and also the funding for lending scheme. On the board behind me, I've just got the quantitative easing bit, and then I'll talk verbally through the forward guidance and the funding for lending scheme on there. Right, quantitative easing then. So what we want in the UK, we want growth, and we just want people to go out and buy more stuff. And if they buy more stuff, that will create more demand, and that will set the whole economy going. Now, one of the things that's happened in the UK economy is there's been a lot of blockages within the system. And the central bank, the Bank of England, has tried to keep all of this going. So consumers may not be spending on the firms. The banks may not be lending to firms. And at one stage, we were getting to the stage where the banks wouldn't even lend to the banks. So if any of those blockages occur, that could set the whole economic growth pattern on a downward spiral. So over here, I've got low interest rates with the consumers here. If the consumers are afraid to spend, then even a very low rate of interest is not going to make them spend. On top of that, actually, when the consumer goes on to the bank, there may be a blockage in the system again because the bank may still be charging quite a high interest rate to the consumer. Right, so eventually what the government has gone out and done is it has electronically created money, and it's paid for, and it's brought up bonds which are also held by the banks. So suddenly the banks are getting a load of cash at 0%. But even then, we don't know whether or not the banks are going to lend out that money, because what a lot of the banks did was they just went and brought some more bonds, and they were able to get a 2% return on those bonds, and that was easy money. So they were getting money for nothing at 0%, and then they were then able to get a 2% return by buying up the government bonds with absolutely no risk at all. Of course, it made the bank stronger, but it didn't do much for the economy. The more worrying thing was that speculators, with that extra cash they had at 0%, went out and they brought up commodities on the world market. So therefore that then created cost push inflation. And if you get cost push inflation, that will then create more instability within the economy, and that's always the danger of that process. So the government can go out, as I previously just said, and they can either buy bonds or even mortgage-backed securities, which are these great big collateralized debt obligations where they put good debt with bad debt, and the government just came along and said, okay, that is a bit of a dodgy asset, but you're in trouble, so we will give you cash, and that will improve your balance sheet, because this asset here may be grossly overvalued, but at least if you've got the cash in there, then you know how much you have a greater idea of how much your balance sheet is worth, and you've definitely got that money. Now, by buying up the bonds, that pushes up the price of the bonds because there's an increase in demand, and that will create less of a yield on bonds. So that will hopefully push people away from buying bonds, even though I've just said the banks may go out and buy bonds because they will lend money at 0%. Okay, on top of that, particularly in America, the exchange rate will fall. Well, the exchange rate also fell in the UK. Now, that was probably quite a good thing for the UK. And actually in the UK, we were sort of okay, because it's not a lot of, in the UK, we do not have a lot of international investors owning UK government debt. However, in the American economy, they've got a lot of it's the Chinese who own a lot of American debt. Now, in that case, if the exchange rate falls, the bonds that those Chinese people hold are worth less. So it didn't really please the Chinese, and in the future, when the American tries to sell its bonds again, the Chinese may not be willing to buy up their bonds. What else has happened is, if I give you the quick example here of gold, which is obviously a commodity, gold is now about, I think it's about $1,300 per ounce. Gordon Brown, when we had it in the UK, sold it at $250 an ounce. Now, the reason why gold has gone up by so much is probably because of all this printed money that has been used to buy up gold. And then the bankers make bonuses from that. But actually, that, if you buy up enough commodities, that will eventually lead to inflation. Okay, so quantitative easing is good. I mean, it's a really good idea, but however, we can't guarantee. It seems a really weird one to me, where you give the money to the bankers who've already created some of the problems. Now, that's the reason why the funding for lending scheme came in, which seems to me, why didn't they start with this one straight away? Now, the funding for lending scheme was originally used for both firms and people who wanted to buy houses. But actually, the funding for lending scheme has been cancelled in the housing market because the housing market is already taking off. And that allowed people to borrow money at low rates of interest when they went out and bought a house. That would increase the demand for housing. Therefore, house prices would go up. Therefore, more houses would be built. But actually the house prices in the UK are going gangbusters anyway, so we don't need the funding for lending scheme for that. But the funding for lending scheme now is directed solely at small, medium enterprises, small businesses. And if the banks lend money out to businesses, they are guaranteed the government will back that loan. So the banks will have to make a decision on whether or not the business will be able to pay it back, but they know that if the business cannot pay it back, they'll be guaranteed by the government, so therefore the business will be able to borrow at a lower rate of interest, and that should get money directly into the real economy. I can't understand why we just can't have a government bank that does that and then all the businesses would go there, because ultimately it's those small and medium enterprises which will then go on to create future businesses, which will hopefully create the growth and innovate and shift out the long run aggregate supply curve. So monetary policy these days, because of the trouble that we were in, is far stronger than it's ever been in the past. We've got incredibly low interest rates. Our exchange rate has fallen at a maximum of 25%, although recently it's gone up. And at the same time, we printed a lot of money, and the latest one of those schemes is the funding for lending scheme, which is directly getting money into businesses, which is a great idea.